What if there was a way to grow your wealth while keeping your investments simple? ETFs might just be the secret ingredient to diversify your portfolio, lower fees, and maximize returns. I'm going to show you exactly how they work and why they're so popular. ETFs, or exchange-traded funds, are often called an easy way to invest because they let you own a basket of assets with just one purchase. This means you can invest in a variety of stocks, bonds, or even commodities all at once, simplifying your investment process without the hassle of picking individual stocks or bonds. One of the key reasons ETFs are so popular is because they offer flexibility. They trade on stock exchanges, meaning you can buy and sell them throughout the day, just like individual stocks. There's no waiting for the end of the trading day like mutual funds. You have full control, but perhaps the best feature of ETFs is their ability to spread risk. By owning an ETF, you're spreading your investment across a broad range of assets. If one stock or bond isn't doing well, others in the ETF might be doing great, helping balance things out. Most ETFs are passively managed, meaning they simply track an index like the S&P 500. But there are also actively managed ETFs where a manager selects assets in an effort to outperform the market. While passive ETFs are usually cheaper, active ones offer potential for higher returns, though they come with higher fees. Active management doesn't mean they will outperform passive funds. One of the most attractive features of ETFs is their low cost. Passive ETFs generally have lower fees compared to mutual funds, making them a cost-effective option for long-term investors. There are different types of ETFs, and that's part of their appeal. You have broad market ETFs that track the entire market, sector ETFs that focus on specific industries like technology, healthcare, bond ETFs that invest in fixed income securities, and thematic ETFs that focus on trends like artificial intelligence. There are two main ways to earn with ETFs: capital appreciation and dividends. If the value of the assets in the ETF goes up, so does the ETF's price, allowing you to sell for a profit. Some ETFs also pay dividends, providing regular income from the assets they hold. However, it's important to remember that ETFs can also decline in value, meaning you could experience losses if the underlying assets don't perform well. ETFs are highly accessible for beginners. You don't need a lot of money to get started. On most trading platforms, you can invest in ETFs with as little as $1. If you want exposure to the US stock market, you could buy an S&P 500 ETF like Vanguard's VOO. Instead of buying shares in all 500 companies, you buy one ETF that gives you a slice of each. It's a simple, cost-effective way to diversify across the US market with a single trade. If you're more interested in focusing on the tech sector, you could consider a technology-focused ETF like Vanguard's VGT, which gives you exposure to top tech companies like Apple, Microsoft, and Nvidia, all within one fund. If you're looking to build a well-rounded portfolio, these ETFs offer a simple yet powerful approach to diversification. Whether it's broad market exposure with an S&P 500 ETF or tech-focused ETFs like VGT, there's an option for every strategy and interest. So which type of ETF sparks your interest the most? Broad market, bonds, tech-focused, or any other category? If you've already started investing in ETFs, share your experience in the comments. If you want to learn more about the top performing ETFs, be sure to check out this video right here. And don't forget to like, subscribe, and hit the bell for more ETF insights.